Welcome to the lecture on income tax planning, and after the lecture, we will be able to learn the following objectives. Explain the principle of gross income, define the exclusions from gross income, understand personal and dependency exemptions, explain the important issues of income tax system, define basic income tax planning concepts.
Let's start with a brief introduction of income tax planning. A working knowledge of tax law enables you to help clients as well as to know when to seek assistance from a tax expert. Therefore, here we explain basic income tax concepts and introduce ways one can help a client plan for tax minimization and or tax avoidance with the context of the client's overall financial plan. A tax plan that focuses on tax minimization and or tax avoidance is a poor plan if it is inconsistent with the client's other financial goals. Nevertheless, almost all clients want to minimize and or avoid paying taxes. Let's now take a look at the principle of gross income. Basically, gross income includes every item of value, including money or other property that is either made available to or comes into possession of the taxpayer. In other words, every item of value is included in gross income for income tax purposes unless this qualification is very important. The Internal Revenue Code contains a specific provision that excludes the item from the taxpayer's gross income. Gross income means all income from whatever source derived. However, certain items of money or other property are not includable in a taxpayer's gross income. These items include gifts, income from tax-exempt bonds, workers' compensation benefits, and many other items. Here we will discuss about the exclusions from gross income. The Internal Revenue Code states that many items are excludable from a taxpayer's gross income. Among these items are gifts and inheritances, income from certain bonds issued by states and municipalities, so-called muni bonds, workers' compensation benefits, life insurance proceeds, benefits paid from medical expense insurance policies. It is important for one to understand the concept of exclusion and know how exclusions are used in the overall process of computing an individual's tax liability. Deductions. A deduction is an item of expense that reduces the amount of the taxpayer's income subject to tax. Many different items are deductible for federal income tax purposes. However, before we discuss some of these items, one must understand the concepts of adjusted gross income, AGI, and taxable income. Adjusted gross income. Adjusted gross income, AGI, is an intermediate calculation made in the process of determining an individual's income tax liability for a given year. Adjusted gross income is defined as one's gross income from taxable sources minus allowable deductions such as unreimbursed medical expenses, alimony, and deductible retirement plan contributions.
Adjusted gross income is the amount of income you collect after all qualified income is summed together and all the qualified deductions are subtracted. For tax purposes, the adjusted gross income figure is used to determine whether a taxpayer is eligible for certain tax benefits. The first step is to determine gross income, which is any money earned in a calendar year. Gross income includes wages, tips, interests, taxable Social Security benefits, dividends, capital gains, royalties, income from retirement accounts, alimony, etc. The income received from any of the gross income sources is added together. Once gross income is added, you then subtract any alimony paid, any student loan interest, moving expenses, any qualified medical expenses, etc. This total is the adjusted gross income. For tax purposes, this amount is the net amount of income that is taxed.
Taxable income. Taxable income is the amount of income actually subject to tax in a given year. Taxable income is the taxpayer's AGI reduced by certain deductions applied only after the individual's AGI has been computed. In other words, in the computation of an individual's tax liability, there are two basic types of deductions. The first type consists of those deductions subtracted from gross income to determine AGI. The second type consists of those deductions that are subtracted from AGI to determine taxable income. AGI is used as a base for defining or limiting to what extent certain other items may be excluded or deducted on the individual's return. The second reason relates to the concept of the standard deduction.
As you know, most income is taxable and must be reported on your federal income tax return. But what you may not know is that some income is only partially taxable or not taxed at all. For example, child support payments, gifts, inheritances, and welfare benefits are usually tax-free. On the other hand, income may be taxed in some situations, but not in others. For example, Social Security benefits are usually tax-free, unless your income is above certain levels. In that case, you pay tax on part of your benefits. Court awards or settlements for personal injury or sickness are normally tax-free, but punitive damages or compensation for lost wages are usually taxable. Money you take out of a traditional IRA is generally taxable, but money you take out of a Roth IRA is usually tax-free. But remember, income such as wages, salaries, tips, and bartering is taxable.
The standard deduction or itemized deductions. The standard deduction is a fixed amount that the individual may claim in lieu of claiming itemized deductions on Schedule A of Form 1040. Itemized deductions or deductions listed on Schedule A include medical and dental expenses, certain taxes, certain interest payments, charitable contributions, casualty and theft losses, and miscellaneous itemized deductions. The amount of the standard deduction depends on the tax status on which the individual is filing the return. That is, as a single taxpayer, an unmarried head of household, a married taxpayer filing jointly, or a married taxpayer filing separately. Categories of deductions. There are three basic categories of deductions allowable to individual taxpayers. The first category includes deductions for expenses incurred in the course of carrying on a trade or business. The second basic category includes deductions for expenses incurred in the course of an activity that is not a trade or business, but is intended to produce income and make a profit. The third basic category includes deductions for some expenses that are simply personal, family, or living expenses.
Are you trying to figure out if you should itemize or take the standard deduction? You know, it can make a difference in how much you pay in taxes or how big your refund will be. If you file electronically, the tax preparation software will figure this out for you. But if you use our fillable forms to e-file, or if you file a paper tax return, you'll need to add up how much you spent on things such as mortgage interest, medical care, and charitable contributions. The instructions for Schedule A list all the expenses that qualify. Then you'll need to compare that amount with the standard deduction for your filing status, such as single or married filing jointly. You can find the details in the Form 1040 instructions. Whichever amount is bigger, either the standard deduction or the itemized deduction amount, that's the one that'll give you the biggest tax benefit. You can download any of these forms and their instructions on our website. Or better yet, why not e-file and use tax preparation software? That way, all the calculations are done for you.
Depreciation, a special type of deduction. The most important non-cash deduction is the deduction for depreciation. The depreciation deduction allows a taxpayer to recover the cost of certain property by allowing the taxpayer to deduct a specified portion of the cost of the property each year against the taxpayer's income. Depreciation is a deduction that often does not represent economic reality, such as when the property appreciates while it is in use. Thus, there is an element of social policy behind depreciation rules in the tax law. Let's now get to know about personal and dependency exemptions. Each individual taxpayer is allowed to claim a personal exemption for him or herself. Individual taxpayers are permitted to claim a dependency exemption for each dependent individual supported by the taxpayer. There are strict rules regarding in what a taxpayer may claim as a dependent and under what circumstances. The exemption amounts change as they are indexed annually for inflation. Tax rates and brackets. Once the taxpayer's gross income has been determined, all above-the-line deductions allowed are subtracted from gross income to determine adjusted gross income, AGI. The taxpayer's taxable income is the figure to which the income tax rates are applied to determine the amount of income tax due for the year. Effective tax rate. The brackets of taxable income to which the various marginal tax rates apply depend on the individual's filing status. An individual taxpayer files his or her tax return under one or four filing status categories. A single taxpayer, an unmarried head of household, a married taxpayer filing jointly, and a married taxpayer filing separately. The amount of taxable income in each tax bracket depends upon the individual's filing status. Tax credits. A tax credit is a dollar-for-dollar reduction of the actual tax owed. Deductions, on the other hand, only reduce the amount of income subject to tax. Both are good for the taxpayer, but credits are much better than deductions. 4 of the most important tax credits available to individual taxpayers are: 1. The tax credit for children. 2. The adoption credit. 3. The dependent care credit. And 4. Credits for higher education. The alternative minimum tax, AMT. The alternative minimum tax, AMT, is a separate method of calculating income tax liability. It is often referred to as a parallel system of income taxation. It applies in cases where the calculation of the AMT results in a higher tax liability than the calculation of the regular income tax. The purpose of the AMT is to prevent the taxpayer from reducing his tax liability below reasonable levels through the use of certain tax benefits targeted by the AMT rules. Tax periods and accounting methods. Individuals file tax returns on an annual basis. For the vast majority of individuals, income tax is calculated based upon a calendar year period. However, many partnerships and corporations, and a small number of individuals, report their tax liability based upon a 12-month period that does not coincide with the calendar year. Taxable income must be computed on the basis of a fixed accounting period, that is, a taxable year, and complying with a method of tax accounting that clearly reflects income. The popular method of accounting is the accrual method, which typically is used by C corporations. Under this method, income is realized and reported for taxes when the right to receive it comes into being. That is, when all the events that determine the right have occurred. Let us now take a look at the important issues of income tax system. To understand the income tax system more fully, it helps to consider three basic issues in addition to the computation process. These three issues are: what is taxed, to whom is it taxed, and when is it taxed? The what issue. The economic benefit doctrine. We discussed the question of what is taxed in the section when we described the concept of gross income. In general, anything of value received by the taxpayer is taxed, unless it is specifically excluded, such as a gift. An event or transaction that confers an economic benefit on the taxpayer will result in gross income to the taxpayer, as long as the economic benefit is certain and can be measured. The to whom issue. The fruit and tree doctrine. There are many types of assets that produce taxable income. The asset producing the income may be a corporate bond that pays interest, or it may be some real estate that generates rental income. The asset may be an individual whose knowledge or expertise generates income from sales or services. In any event, an important tax principle that applies is this: income is taxable to the person who earns it, or to the person who owns the asset that produces the income. The when issue. The constructive receipt doctrine. An important doctrine that limits the use of such delaying techniques is referred to as the constructive receipt doctrine. Without this doctrine, cash basis taxpayers could shift, almost at will, the year in which they report income merely by not taking any steps to physically possess the income that is due to them. Under the doctrine of constructive receipt, a cash basis taxpayer is deemed to have received income for tax purposes when it is either credited to the taxpayer's account, set apart for the taxpayer, or otherwise made available so that it could be possessed by the taxpayers, even if the taxpayer fails to actually take possession. Let's now take a look at basic income tax planning concepts. The tax is saved through tax reductions or avoidance through a reasonable interpretation of tax laws and not through tax evasion. Some basic concepts used in tax planning to illustrate how accountants, tax attorneys, and other tax advisors help clients minimize and/or legally avoid taxes are income and deduction shifting. The principle behind income shifting techniques is this: get taxable income into the hands of a taxpayer in a lower tax bracket than the taxpayer who would otherwise have to report the income. Proper income shifting techniques result in less tax paid on the income. For planning purposes, a technique somewhat related to income shifting is deduction shifting. As a result, the deduction is taken against income that would be taxed in a higher tax bracket, thereby resulting in a greater tax earnings. Avoiding limitations on deductions. Although many types of expenses are deductible for the income tax purposes, there may be limitations on how much of a given expense may actually be deducted. One common way the law limits deductions is through the use of a deduction floor. The taxpayer is allowed to deduct items subject to the floor, but only to the extent those items exceed a specified percentage of income, specifically adjusted gross income, AGI, in most cases. Deferral and acceleration techniques. Deferral of income and acceleration of deductions are basic and common tax planning techniques. These techniques are based on the time value of money. Deductible expenses are accelerated into an earlier tax year. The tax savings from those deductions is realized sooner, thereby giving the taxpayer the use of that money sooner. The passive loss rules. The IRS places special limitations on the deductibility of so-called passive losses. These tax losses are typically generated by activities in which the taxpayer has an ownership interest, but does not participate in the activity of the business. The basic rule, however, is that tax losses generated by passive activities can be deducted only against income generated by the taxpayer's passive activities, and not against salary or other income of the taxpayer. Tax-exempt transactions. One of the best tax planning techniques is creating a transaction that produces a monetary benefit without the taxpayer being taxed on that transaction. Within this general category are two basic types of transactions. The first is where taxation is altogether eliminated, and the second is where taxation of the transaction is merely deferred. The taxpayer is subject to a high marginal income tax rate. The interest rate on such bonds will generally not be greater than the after-tax rate on taxable obligations, non-recognition transactions. There are many types of transactions in which taxation is merely deferred rather than eliminated. These transactions may generally be referred to as non-recognition transactions. Computation of gain or loss. When property is sold, the taxpayer must determine what portion of the sale proceeds will be subject to taxation. In general, the gain realized from a sale of property is equal to the total amount realized from the sale, minus the taxpayer's cost basis in the property. How non-recognition transactions differ from taxable transactions. Generally, a taxpayer's cost basis in a property equals the cost of the property. In an exchange of property, the taxpayer's cost for the property received in the exchange is generally the fair market value of the property surrendered in the exchange. Transactions that result in a taxable loss. Some sales of property result in a loss rather than a gain to the selling taxpayer. This happens when the amount received for the property is less than the taxpayer's cost basis in the property. In such cases, the dollar amount of the loss is generally deductible for income tax purposes if the property sold is either business property or property held for the production of income. Taxable entities. Certain corporations can elect to have their shareholders taxed on the corporation's taxable income. This is called a Subchapter S election. The effect of such an election is to have the corporation treated for tax purposes very much like a partnership. Partnerships and Subchapter S corporations are often referred to as pass-through entities because the responsibility for paying their taxes is passed through the entity to the owners of the entity. Now, in the end, let us summarize what we have learned in this lecture. The best tax plan is one that accurately reflects the client's overall financial goals. A working knowledge of tax law enables to help clients as well as to know when to seek assistance from a tax expert. Gross income includes every item of value, including money or other property that is either made available to or comes into the possession of the taxpayer. A deduction is an item of expense that reduces the amount of the taxpayer's income subject to tax. Taxable income is the amount of income actually subject to a tax in a given year. The most important non-cash deduction is the deduction for depreciation.